Thank you for joining us today in this very intimate session where we will explore two things. Why are insurance rates going so high? And whether or not this is a great opportunity for us to invest in the insurance industry. I'm going to start by telling you my own story. After 26 years in the insurance industry, having worked for big, large multinational insurance companies, I decided to start my own business. And I created a platform to connect capital from family offices down to insurance risk portfolios, like the ones we're here to talk with Jean-Louis Monnier. Let me tell you a little bit about him. Jean-Louis has worked at Swiss Re since 2002, moving through increasingly senior and ILS-focused roles at the company. ILS means insurance-linked securities, and that's the connection between capital and insurance. He became the head of ILS for the EMEA region in 2008, then in 2015 took on responsibility for property and casualty structured solutions in UK and Africa, and also became the global co-head of Swiss Re business. His current role, which Jean-Louis stepped into 2019, is as head of retrocession and ILS structuring of Swiss Re Alternative Capital Partners divisions. Jean-Louis has also taken on the CEO position for the Swiss Re Capital Market Corporation broker-dealer business as well. Palmer sits with Monnier's team and leads ILS structuring for EMEA and APAC, and is based in the UK. And that's Jean-Louis. We're very honored to have him here today with us. We are very happy to hear it from one of the largest reinsurers in the world. And Jean-Louis, congratulations on your recent promotion, being now president of the whole division. We're very happy to have you here today. Good morning and welcome to YPO.
Thank you, Alex. So we've definitely been through some very interesting times, in our markets, and you may have experienced it yourself in your businesses, or heard about the various influences that inflation and other markets movements have led, or the impact they've had on reinsurance. So I've prepared a few slides to go through, starting with understanding, how the risk transfer market works in simplified terms, but terms that I think quite important in terms of understanding the dynamics that we've been through, and then focusing a bit on the impact it has had on the full reassessment of the price for insurance risk, and then going into a bit of details about what sort of risks are being seeded in our markets, and why capital markets is so important today in terms of providing the ever increasing limits that our economy requires in terms of insurance coverage. So let me share my presentation here. I hope you can. I need to just access it. Just 1 second. But before. Okay, now we're good. So to start with, I really wanted to focus on the chain of reinsurance risk transfer, and I think it's very important to understand the various participants, in that chain, and the role they play, and how they are, at each stage, retaining some elements of risks. So I think that there's always an alignment, throughout this process of seeding insurance risk, but how this benefits, to the overall market. So the first one in line are insurers, and really, insurance companies are the first line to underwrite risk, originate risk from individuals and corporations. They to some degree mutualize the risk, across a region, across product lines, and sometimes, like nationwide for some of the larger insurers. And obviously they have quite large number of staff, able to handle claims and service their clients. But ultimately, they don't retain a lot of their risks. Why? Is simply because they're not, from a capital standpoint, they're typically not the best place to retain that risk, because they tend to be quite concentrated. Usually, insurance companies would operate either on the property side or the life side. So already there's this division. Sometimes it would be regional players, and their portfolio, even though they can mutualize very well certain risks, like it could be accident risks on a portfolio of auto insurance, for instance. Or it could be risk more related to individual homes or individual companies. There are some extreme perils that have the potential to affect a very large chunk of their portfolio and lead to extreme losses. And that's really the tail cat insurance risk that they would cede to reinsurers. Typically in excess of a retention that maintains alignment, so that they, it's a very different process than maybe what happened back in the days in the banking world, where you had, for instance, mortgage underwriting that was done via ultimately institutions that didn't retain skin in the game. Insurance companies have a lot of skin in the game when they underwrite perils, but ultimately they're not the best suited to keep the tail. Why? Because they're not diversified enough. So they would cede the risk to reinsurers, and reinsurers ultimately are better placed to do so because they take risks around the world. So they have global diversification across regions, across perils, across life, non-life, property, casualty, which leads to a lower cost of capital. And that's, they typically have a strong rating, so they focus indeed on the capital usage, and they do end up, because of the demands of the market, with some accumulation risks in certain areas, and the US is one. And in particular in the US windstorm is a big risk, Florida being an extreme one, where for some reasons, there's been a lot of growth towards actually areas and states, growth in populations and built that are actually prone to catastrophes. So Florida being one, and when it comes to earthquake, California earthquake is where there's basically the biggest risk of exposures. Now, the good thing is that from a capital market standpoint, capital markets by and large have very little exposure to these risks. So what reinsurers do when faced with this, both from a risk management purposes in terms of limiting their potential maximum loss on events, but also from a capital relief purpose in managing the capital on their balance sheet, they turn to capital markets investors. Now, for capital market investors, any insurance risk pretty much at this stage is a diversifier. Investors are by and large not exposed to insurance risk. Why is it a diversifier? Because it's pretty much not impacted, or the underlying risk is not man-made, and it's not impacted by any systemic financial risk, for instance. And investors have found out that in times of extreme stress, during the financial crisis, for instance, or periods of heightened financial distress, there could be a situation where all financial assets behave in the same way. And even recently, with the rise in inflation, you've had actually equity and bonds going down, which hasn't happened in quite a long time. So that's really the attraction from capital market investors. Interestingly as well, they don't have a cost of capital per se. All this market is collateralized, which means that when an investor takes $100 million of risk on a certain transaction, they need to put up 100 million in cash in collateral because they don't have the rating otherwise to provide that coverage. So investors focus on the return on collateral deployed. And so they actually have a preference for the peak perils, the ones that pay the most. They have a preference for US wind, US earthquake, and they're very exposed to these perils. And then their investment happens in various forms. Catastrophe bonds is the most public side of the market, and these are basically issuances that are, placed with qualified institutional buyers that have, very clear modeling and, quite a lot of information provided on the underlying exposures that they cover. And then you have collateralized reinsurance, where effectively investors are, aiming to step in and, take up or mimic the role of a reinsurer, but they collateralize the limits. And that's a part of the market that has maybe grown since 2011, but really not, started to shrink due to relatively poor performance in the last 3 years. ILWs, which are indexed industry loss, products, and sidecars. And sidecars is an investment where effectively an investor takes risk alongside a reinsurer, but effectively taking risk on the liability side of the balance sheet and not the asset side. So really some clear underwriting risk and taking a share of that exposure alongside a reinsurer.
Yeah, Jean-Louis, we have a question here from April Joyce, very relevant to your train of thought right now, which is how have the recent rate increases changed investors' appetite for the market? What would be your thoughts around that?
Yeah, so I'm going to talk about the rate increases we've seen. It took a bit of time to kick in, but we have seen probably since February, March, quite a large increase in capital towards cat bonds. So cat bonds is the area today which so historically has performed the best and which is attracting new capital. The type of investors that are piling in are pension funds and so long investors with a long-term view, and they tend to, and also we've had some opportunistic capital from hedge funds / private equity money, some looking at more sidecar transactions. So this like these two sides of the market, the more safe and liquid cat bonds and maybe the riskier sidecars. We've seen an increase in interest from hedge funds, private equity, or long-term institutional buyers. In terms of quantity, I'll talk about the size of the market later on, but the cat bond market is a bit less than 40 billion, 36, 38 billion. We have seen probably about like 3 billion to, I would say 3 to 4 billion being raised in recent months. So it's quite significant for our market. It's small compared to global assets, but it's significant for our market.
But an increase in fact. April, you had a comment.
I did actually. That was very helpful. And then in terms of interest rates, so I'd certainly seen over the last decade or so that when there wasn't a lot of other places to put your money, it was interesting to put your money into insurance. I'm wondering now what you're seeing, given there are, your cash in the bank can earn you 4%, if that's changing investor appetite for the maybe perhaps the non-critical cat space.
So our market is, floating rate based, the cat bond market. So you receive the returns from treasury money market funds typically, plus a spread. So you've had sort of a double whammy of an increase in the floating rate returns and then the spread. So the spread over or the spread margin, I would say, so over the collateral return and over the expected loss, so the estimated risk of the transaction has increased in an environment where also credit spreads have increased and risk spreads in general have increased. So I would say, so in that sense, this is what attracting new money. I actually have a slide on this, and I can just, if you want, touch on, on that. So here you have, from an investor perspective, this is what happened, and you can see that, this, what we have here, we look at the Swiss Re Cat Bond Index, which is like a weighted benchmark of the market, of the cat bond market, so the public side of the market, that trades. And you have various things here. You have in light blue at the bottom, the treasury money market yield, average yield. So this is the return on the collateral on this transaction. Red, you have the weighted average yield, so the combined yield. So you can see that now it's oops, sorry, I have my video on that. I can't see the right hand side of the charts here, but okay, now I can. So it's around like 15%, total yield, which is good. The blue line is maybe something which is more representative of the evolution of the risk spread, is the margin in excess of the expected loss. So that's effectively, and the expected loss is a measure of the risk being transferred on each individual transactions. So you can see that through effects that I'm going to cover, but from like November 21 to November 22, so end of year of last year, it was an extremely sharp increase in the spreads being paid to investors, and with in an environment where new money had not been raised yet, or was a bit slow to come. Obviously, you had Hurricane Ian that didn't help. This is that you see that there is an initial rise, then an inflex, and then a sharp rise again, and that was also following Hurricane Ian.
Yeah, this is a graph that got me into business, into venturing myself. I think this is the moment where things are happening in the insurance industry and the opportunities are being open for us to move in.
So, but to give you a bit of perspective why this is happening. So two things. First of all, in terms of risk transfer, so we're transferring insurance risk and there's a demand for coverage, and that demand is also associated to, an increase in average property losses. And here you can see the historical insurance loss for, going back over 30 years. And yes, there is a trend for increased losses in recent years, which has not helped the reinsurers ultimately, because reinsurers kept a lot of that burden. Interestingly, the price of reinsurance has not took a long time to move. And what really led that move in recent years has been just the increase in demand for capacity due to inflation. At a time where actually the capacity and the balance sheet of reinsurers was, if anything, shrinking due to market movements and on the asset side. So that's what I illustrate on the next slide. So you have here on top a chart from a recent market analysis, including the reinsurance capacity that was provided by Aon, and on the bottom we have here more the cat bond capacity and as it grew, so as compiled by Swiss Re, and you can see that when it comes to the global reinsurance capacity, due to the increase in rates and so on, and the impact that this has in the way assets are being treated on reinsurers' balance sheets and the overall performance of the assets, you actually had a shrinkage in available capital from global reinsurers. The component that comes from alternative capital, which is the light gray, here around 90 million, 93 million for estimated 2022. This has remained quite stable. But within that component, there's one part which has been growing consistently and which is continuing to grow, and it's the cat bond space. And that's what we illustrate below. You can see that throughout the years, cat bonds have, or the size of the cat bond market has increased. So this has happened also in a background where the demand for cat cover, so natural catastrophe cover from insurers, has dramatically increased with a direct link from inflation at the end of the day. So if the cost to rebuild a home and due to inflation is increasing, insurers have to insure to value. And so the total insurable values that they have in the portfolio are just increasing, and this directly, leads to higher demand for capacity. And the reinsurers were unable to really upscale a lot. So we talked about asset performance. Underwriting results also were not great, so that didn't help, their capital. And this was global. With Hurricane Ian, in the end, will not be, as big as maybe it was feared. But you had hail and flood losses in Europe. You had Australian typhoons and floods. So a range of, also frequency events that led to losses. The previous years, you had the pandemic that ended up having also an impact on the property side due to business interruptions, which was maybe also not factored in as it should have been. Cost of capital is going up. The ability to issue also, sub debt at decent spread, well, spreads are higher basically on these tools. And there's a relative scarcity of retrocession capacity. So retrocession is the ability for a reinsurer via sidecars to entice capital market investors ultimately to come in. So this is where really the capital markets, or the ILS side, the more public side of the market, we expect it to grow and fill that gap. And it's taken a bit of time, but now we're seeing the capital being raised. And we're quite optimistic that also sponsors will be coming in to market. And also, so we talked about the recent spreads, but also from an investor perspective, why would an investor do this? Well, we talked about diversification, but this is history based on the Swiss Re Global Cat Bond Index total return in red, and compared to the corporate high yield or S&P 500 total return. So as you can see, in terms of performance since then, it's a bit lower than high yield and equities, but the volatility has been way less. And in particular, during the financial crisis, so 2008 to 2009, yes, you can probably see a very minor fall due to the big liquidity crisis there was following Lehman failure. But very minor, and they are, the bumps you've had were like in 2017, Hurricane Irma, which created more of a scare that losses could be very large. They ended up being actually not as large as at one stage feared. For some reasons, hurricane have a habit to make landfall in over a weekend. So the week before, everyone is scared, and then you look at what's happened. And recently, Hurricane Ian, as you can see, led to a fall in our market, which has then recovered. So very different from a correlation standpoint than the other assets, and that's what makes it attractive. So this we touched on, and why are we optimistic that also more money could come? Because if you look at the relative size of our market and in particular alternative capital, it's still very, very small. And there is actually, when I said 2018, sorry, this is a mistake on this slide, it's 2023 or reinsurance capital. It's 560 billion. It's down from from the previous years. And you have alternative capital being around 17% of that market. And that the 560 includes also alternative capital, so 83% being traditional. And when you compare this to, the potential parts, and here we just look at the global, pension assets, you could see that the pension fund could have a relatively small allocation to ILS. And if you have a few more doing this, then that would help actually a lot, the sort of capacity constraints that we have. Some investors, a lot of pension funds are invested into our space. One which has been quite public about it is PGGM, one of the largest Dutch pension funds. Others are more private and sometimes investing, not directly, but they're investing through dedicated asset managers.
So Jean-Louis, would it make sense to think that if traditional reinsurance capital is staggering and stable or even decreasing a little bit, then the only way that insurance prices are going to go down is when alternative capital walks into the room and starts creating more capital? Would that train of thought make sense to you, or how would you see the pricing trends and the capital coming into the market in the next few years?
Well, that's interesting because ultimately these are markets that also operate under different dynamics. So what we have seen in Q4 of 2022 is the ILS market actually overshooting and becoming quite a lot more expensive in some areas than traditional ended up being in January. There was uncertainty in terms of where traditional would settle, but the market sort of overshot. And the main reason, well, there's various reasons, but the fact that our market is mainly in dollars and dollar was also extremely strong didn't help during that period, because you have some investors that are euro-based that saw effectively the footprint that that became in passive breach from an allocation standpoint and couldn't increase their investments. So that definitely didn't help, and you had some investors wanting to wait and see before actually deciding to invest. So this has now changed, and the market is more liquid and has corrected back, probably more in line with traditional. The reason why we don't think that we're not going to go back to the prices we witnessed, a year ago, it's because I think reinsurers are, on one, more disciplined. Two, I think, alternate or capital markets investors, they don't intend to replace insurance companies. So it will always be or reinsurers. It will always be a complement to reinsurance capacity, in the sense that the risks that are being ceded tend to be the cleanest, the ones that can be the most easily modeled and understood by capital markets investors, and ultimately just the peak capacity. Once you remove those peak risks, a reinsurance balance sheet is actually quite efficient to hold the remainder of the risks. So there is a point where doing, for instance, a cat bond it's quite resource intensive. It's there's some cost involved. It's really worth it ultimately as to support the growth at the end of the day as a complement to traditional. The reason why we're optimistic is because we see growth coming, and we see that if you consider what happened with insurers in the last renewal, they typically increased their retention, and probably a bit more than they wanted to, because the capacity was relatively scarce. They were a bit concerned that capital markets prices were too high, so some of them paused and waited in the sideline. These sponsors are going to come. So those insurance companies, like we're in touch with a number of nationwide insurance companies that are going to come to market next year and do relatively large size. And we're very optimistic that capital will be raised to meet those issuances. at levels that probably will be similar to what we're seeing today. So we don't see, we think that, there was a bit of volatility, but now the market has stabilized at a level that, that probably is sustainable, and will reward, at this stage, will probably reward risk, relatively handsomely. But remember that, I think it will take a few years of good underwriting performance, maybe for the market to soften again. But people have short memory. Now they look back at, and this is everywhere. You look at recent years, and so yes, maybe in a few years the market will change. But we do anticipate that the hard market will continue for some time.
Will continue for some time, thus creating investment opportunities for a while.
Correct. So in terms of like taking a look at what has been seeded, it's mainly nat cat, so natural catastrophes. Yeah. So this is historically from the start of the market, so the total limits that have been seeded. So you can see that from the non-nat cat side, there was a bit of a mix of things, auto, credit reinsurance, event cancellation, extreme morbidity, extreme mortality, which was one of the bigger chunks, so pandemic cover. So there's been inroads here and there, but the core of the market is nat cat. This is where the demand is. And if we look at where in nat cats, overwhelmingly North America, or some US exposures. Some transactions are worldwide, including US, a number of those. But the bonds that are non-US exposed is about like 4.1 billion of the market. So number one, I was indicating that this market really absorbs the peak risks. This is what it does, and this is what it does best, and it gets paid for it. I mean, you have some outliers here, like Chile. So we worked on a transaction for Chile, and Chile has indicated intention potentially to to do more, and this is the government of Chile that wants to provide resiliency in a country which is heavily exposed to earthquakes. Similarly, with the transactions, so these transactions that we did with the World Bank for Mexico, that's a fund, then in Jamaica, same thing, sponsored by the World Bank. Yeah. Otherwise, more the private market, we have some transactions being done by European insurers, mainly for European windstorm, and in Japan for earthquake and typhoon. But the core of the exposures being seeded is US wind, and US earthquake, mainly California. It's interesting because in California, I think insurance penetration when it comes to like mortgages is below 15%. So you have a massive protection gap, and still California earthquake is a big peril for the industry as a whole, and also for capital markets. So there is, from a demand side, potentially there is also a need for more coverage. We don't see it coming too much from homeowners at the moment because of the cost of reinsurance. But I think there are some corporations that are also looking into their exposures to earthquake and business interruptions and what it could mean.
So, Jean-Louis, if you are an investor, where would you be looking at? Cat bonds or non-cat ILS? What are your thoughts around that?
So, I think cat bond is used well. I mean, there's two school of thoughts here. For investors looking for high return, within the nat cat space, sidecar is probably the way, where you get some embedded leverage by providing capital to, alongside a reinsurer. And why am I saying embedded leverage is that typically the reinsurer will write all the business on its balance sheet and retain the tail. So the capital market investors will collateralize a portion, but be exposed to a larger portfolio. And there you can get equity type returns, equity type risks as well, but that are not correlated. The cat bond market tends to be more remote layers. So which is why also it has performed the best in recent years, because it hasn't been affected by, by and large, Irma had some impact, but not too big. Irma was a big hurricane. So it doesn't mean that it cannot be exposed, but you need very, very severe events, so events that make the headlines. And this is the market that pension funds, go towards too. Yeah. But pension funds, the largest pension funds end up negotiating managed accounts, quite low fees. We know that these products are sometimes being sold to private banking, for instance, in Switzerland and so on. But there, typically the level of management fees are quite high. So then this is, how much risk are you taking? Net of management fees, what the return, that's an analysis to make. Yeah. So we feel that in my view, it's a market that makes more sense for institutional buyers when it comes to that, that side of the business. And now when it comes to the non-nat cat piece, well, this is one where maybe you can talk with Alex a bit what you do, but we know of some entities that are taking risk in more granular and maybe longer dated risk like casualty, where it becomes harder than to do it in bond form. The moment you have a longer duration and the potential for development and so on, the bond product is a bit harder. So this is an area where Swiss Re capital markets is a bit less involved. But obviously, I think the attraction would be also diversification, and within the diversifier, building some elements of diversification, as long as the returns are attractive.
You're absolutely right. I mean, what is calling the attention of investors more is that this is an alternative investment, and alternative investments are by excellence uncorrelated or low correlated. And in general, both cat bonds and non-cat ILS are uncorrelated to the stock markets, thus providing all that diversification. But the alphas, and that's what is changing in the last couple of years and will be maintained for the next few years, the alpha is good. The alpha is becoming attractive at a point where it's not only about diversification, but sometimes even double digits yields. And that's what is making this space so attractive lately to investors.
I agree. So sometimes, well, I think now it's fairly clear that this market is also there to stay. Yeah. But what I show here is the breadth of use of this instrument, especially in the US. So here we look at the top 25 ILS sponsors. So we call them sponsors because they effectively, like USAA would not issue the bonds themselves. They would transact with a special purpose vehicle that would then issue the notes. And there's a trust account which is being set to secure, the collateral. And what it means as well is that obviously if a note defaults, it would be due to the cat risk, and so you don't have USAA paper, which is AAA, defaulting. You have an SPV, having a loss. But what it shows here is that who are the the largest sponsors and users of cat bonds, and you can see that you have here some of the top insurance and reinsurers. So USAA is the largest, Swiss Re. Also historically, even though we used a bit less cat bonds, recently, but we've been, advocating, pushing and developing this market. The California Earthquake Authority, Citizen. So here you go, USA is nationwide risk, then California, obviously earthquake risks. Citizens would be Florida risk. Then AXA XL, State Farm, Allstate, then Curian, like one of the largest program in Japan, so large, insurers in Japan. So it gives you a sense of, how diverse and deep, this market is from an issuer standpoint or sponsor standpoint. And then, so I don't want to bore you with this, but what this chart, I thought I would, keep it to show how how dynamic this market can be. In lighter green here at the bottom, you have the linear interpolation of deals from 2021, 2022 that were peers to the one that were recently issued, and you have the trend line. Yeah. In gray at the top, this is the trend line for transactions done post-Yen up to February 2023. So a time where the market was probably highest than it's ever been due to capacity constraints, and in green where the market has now stabilized, and I think will remain, like a good medium, I think, in terms of more in line with traditional reinsurance, and where it's likely to stabilize after a period of stress, I would say. And so these are all transactions, and the size of the blobs are the relatively size of the transactions. You can see that some transactions price quite out of line. It very much depends on the type of business that is being seeded, the region in which it's being seeded, whether like the anticipated also claims procedures. There is a lot of analysis that goes into these transactions. And then I just wanted to open up to like what would be beyond Nat Cat. The first one that comes into mind for me is mortality, so pandemic risk. I think we'll probably have to wait a bit for, we anticipate RMS, who is one of the largest modeling agency in the space, to release its model, updated model this summer with the learnings and the findings, around the pandemic. But this is obviously a big risk for insurance companies and reinsurers. It's quite a big risk also for the economy. But that's a risk that can be seeded. Extreme mortality deals have been seeded. They tend to be on a population index data, so looking at actually the number of deaths. And we do expect the modeling agencies to update based on the learnings and simply behavior of various countries and population in the face of the pandemic. So morbidity is more linked to medical costs, and interestingly, the morbidity trade, there's been a few. They haven't been affected too much by the pandemic. Some people might have thought this, but the fact is that, in 2020 in particular, when the mortality rates were higher, people didn't go to the hospital as much. So those costs actually, were contained. Longevity is a tricky one because, here you're talking about a longer, like a risk which takes longer to develop. Mortality is more of a cat event occurring, whereas here, it's more of a trend. So mortality trends or longevity trends require longer dated solutions, and so that makes it a bit more complex. And with maybe the need for commutation, and similar with the casualty. Yeah. One area where we think that there could be a big development in the future is cyber. Given the fact that cyber is one risk which is, on which demand for capacity is increasing, and the potential accumulation of risk is very, very large. So the potential that you could have like a cloud failure that would affect actually many more, entities than you think. And even though the individual limits may be quite small, it may add up to a very large number. Similar to effectively the business interruptions, impact that the pandemic had in 2019, 2020 by, in 2020 by simply, all these businesses being closed. Yeah. And terrorism is one which, used to be more upfront, but on people's minds. I was talking about people have short memories. It used to be a hot topic. Now people don't talk about it that much, but there's possibility to do also terrorism risk with sessions with investors in capital markets. So that's the end of my presentation, Alex. So I don't know if there's any questions.
No, thank you very much, Jean-Louis. I think we should open it up to the room and see if we have any questions from folks in the call. Excellent. Well, I want to thank you, Jean-Louis. I think this conversation has been very interesting. I think I couldn't agree more with you that the opportunities are in the future around the sides of cyber and terrorism and casualty. It seems to be the next frontier for the ILS market. I do personally believe that this is a trend. This is a wave, a big wave of capital coming in from especially private wealth and non-institutional investors into the insurance market. I think your vehicles of Swiss Re and the like of other companies are the right vehicles to invest and get a piece of the action while rates are up. And I personally feel so strong about it that I am making my own business around that. So I strongly support what the insurance industry is doing in securitizing and getting a faster access to capital markets and vice versa. We want to thank you for being with us in YPO, Jean-Louis. We know your time is valuable, and again, congratulations on your promotion. This is your home. Please come back to us and tell us more as things continue to evolve.
Well, thank you very much for having me.
Absolutely. Thank you, everybody.
Bye.